All right, welcome to another deep dive. Today, we're tackling Dear Shareholder by Lawrence A. Cunningham,
Ah, yes, a classic.
a compilation of shareholder letters. Really fascinating stuff from some of the biggest names in business.
Yeah, the Titans, right. We're
Yep.
talking Buffett, Bezos, the real heavy hitters.
Exactly. And the idea here, for our listeners who might not be familiar, is that these
Oh,
letters,
they're gold mines, seriously.
they offer a unique window into how these incredibly successful leaders think, how they make decisions.
It's like getting a direct line to their brain, no filter.
That's a great way to put it. So our mission today with this deep dive is to kind of sift through this gold mine.
Uncover those nuggets of wisdom.
Exactly, to find those recurring themes, those fundamental principles that these leaders consistently return to.
Because if you can understand those, well, you're well on your way to understanding how to build a lasting business.
Okay, so before we jump into those themes, maybe we could start with why these shareholder letters are so important in the first place.
Right, because you might be thinking, don't companies release tons of information all the time?
Yeah, you've got your quarterly reports, your annual filings, all that.
Exactly, and those are important, crucial even for compliance and all the nitty-gritty financial details.
But these letters, these shareholder letters, they serve a completely different purpose, wouldn't you say?
Absolutely. They're way more personal. It's the CEO directly addressing the company's owners, the shareholders.
It's like getting a personal update straight from the top, explaining the vision, the strategy, the thinking behind the big decisions.
And they can get into things that you just wouldn't find in a dry financial statement, right? They can talk about company values.
The long-term vision, the why behind the what.
Exactly. It's a chance to tell the story, to connect with the people who ultimately own the company.
And I've even seen articles, in places like the New York Times and the New Yorker talking about how insightful these letters are.
Oh, yeah. Some even call them literary. Can you believe that?
Yeah.
Not words you usually associate with corporate communication.
Not at all. And I think what's really telling is that a lot of these CEOs, they actually prefer writing these letters over, say, writing a memoir.
Or a traditional business book, right?
Yeah.
They see this as their primary way to communicate their big ideas.
It's a direct line to their shareholders, no middleman.
Shows you how much importance they place on that relationship.
Okay, so let's dive into some of those big ideas, those recurring themes that emerge from these letters. Where should we start?
Well, one of the most consistent and I'd say crucial themes is this idea of attracting and keeping the right kind of shareholders.
Right, like not all shareholders are created equal.
Exactly. And Buffett, he really hammers this home. The investor base, it's not just some random collection of names, it's a strategic asset.
Like building a loyal clientele for a restaurant?
That's the perfect analogy, right? A restaurant, it caters to a certain type of customer, and it does that consistently.
If they keep changing the menu, the atmosphere, people get confused, they don't come back.
Same with a company. You want shareholders who understand your business, who are aligned with your long-term goals.
Who aren't just chasing short-term profits.
Exactly. And Buffett even points out something kind of counterintuitive. High stock turnover, a lot of buying and selling, can actually be a bad sign.
You'd think more activity would be a good thing.
Not necessarily. It could mean that current shareholders, who presumably know the business, are constantly leaving.
Like they're losing faith or something?
It could signal a disconnect between the company's vision and the shareholders' investment horizon.
Makes you think, doesn't it? And this leads us right into the whole debate around stock splits, right? Buffett famously refuses to split Berkshire Hathaway's stock.
Ah, the stock split saga. So his reasoning, it all ties back to this idea of the right shareholders.
So by keeping that share price high, it kind of acts as a filter.
Exactly. It weeds out those who are just focused on the number of shares, the short-term traders.
And it attracts those with a longer view, a value-oriented approach.
Right, those who see the forest for the trees, as they say.
Because the worry is, if you split the stock, make it cheaper, you might attract a whole bunch of investors who are just looking for a quick buck.
Exactly. And that can create volatility, a focus on the short term, and it can distract from the real value creation that's happening within the business.
So Buffett's saying, I'd rather have fewer, more aligned shareholders.
Than a huge mass of people who are just jumping in and out, creating noise.
And he even talks about the actual costs of all that trading, right? The transaction fees.
Oh yeah, those can add up, especially if you have high turnover. He gives an example, a company with, say, a 12% return on equity.
Not bad.
But if they also have 100% annual turnover, meaning every share is traded within a year, well, a big chunk of those gains are just going to fees.
And long-term investors, they avoid all that.
They ride out the ups and downs. They're focused on the long game.
Makes a lot of sense.
Mm-hmm.
Okay, let's move on to another big theme. Capital allocation. This is where things can get a bit technical, but it's so important.
It's the heart of how a company uses its money, right? Do they reinvest it, acquire other businesses, buy back their own shares, pay dividends?
So many choices.
And these letters, they offer a masterclass in how to make those choices wisely.
The core principle seems to be don't just hoard cash, use it effectively.
Yeah, Buffett's big on this. He says any earnings a company keeps, those retained earnings, should only be kept if they can be used to create more value.
More value than if those earnings were just given back to the shareholders.
Exactly. It's like, can the company use that money better than the shareholders could on their own?
And he uses this great analogy about a perpetual bond.
Oh, yeah, it's a good one. Imagine you have this bond, pays a nice interest rate, and you have the option to take that interest in cash or reinvest it.
At the same rate.
Right, so if interest rates suddenly drop everywhere else,
Yeah.
it would be foolish to take the cash, right? You'd want to keep reinvesting at that higher rate.
Right.
And it's the same with the company. They need to constantly assess, are the reinvestment opportunities within the business better than what shareholders could get elsewhere?
So they're always comparing their internal return on investment to what shareholders could get externally.
Exactly. It's a dynamic process, not just a set it and forget it kind of thing.
And Buffett also talks about this distinction between what he calls restricted and unrestricted earnings.
Ah, yes, the different flavors of earnings. So restricted earnings, those are essentially the earnings that are eaten away by inflation.
So the company needs to reinvest them just to maintain its current position.
Exactly, just to keep up with rising costs, to tread water. They can't really be used for dividends or growth initiatives.
It's like they're already spoken for.
Unrestricted earnings, on the other hand, that's the real profit, the extra money that can be used for growth or returned to shareholders.
So it's important to understand what portion of those earnings are truly free, so to speak.
Right, because it gives you a much clearer picture of the company's financial flexibility.
Okay, let's talk about share buybacks, because that's a topic that always seems to generate a lot of debate.
Oh yeah, buybacks, they can be controversial. And Buffett, he has a very specific take on when they make sense.
Not a fan of just buying back shares willy-nilly.
Definitely not. He says there are two key conditions that need to be met. First, the company needs to have plenty of cash on hand.
After covering all their operational needs, of course.
Absolutely, they need to have a healthy financial cushion. And second, the stock price needs to be significantly below the company's intrinsic value.
So they're buying back shares at a discount, essentially.
Precisely.
Mm-hmm.
And when those two conditions are met, buybacks can be a great way to increase per share value for the remaining shareholders.
And it signals that management believes the stock is undervalued.
Which aligns their interests with the shareholders, right? They're putting their money where their mouth is.
But he's very clear that he doesn't like buybacks just to manipulate the stock price.
Oh yeah, he's very critical of that. Buying back overvalued stock, it's like throwing money away.
You're using more than $1 to buy back something worth $1. Doesn't make sense.
And it doesn't benefit the long-term shareholders. It just creates a temporary illusion.
So it's all about being strategic, buying back shares when it truly creates value.
Right. It's not a magic bullet. It's a tool to be used carefully.
Now, what about dividends? When does Buffett think it makes sense to pay those out?
His philosophy on dividends, it all goes back to capital allocation. Can the company generate higher returns on invested capital than the shareholders could on their own?
So if the company has great reinvestment opportunities, they should keep the money and grow.
Exactly. But if those opportunities are limited, then returning the money to shareholders through dividends might be the best option.
Lets the shareholders decide where to put their money to work.
Right. Gives them more flexibility. It's all about what's going to create the most value in the long run.
And it wasn't just Buffett who had insightful things to say about capital allocation. Roberto Goizueta of Coca-Cola, he also introduced a really key metric.
Yes, Goizueta. He was a big proponent of focusing on economic profit.
Which is?
It's basically your net operating profit after tax minus the cost of capital.
So it's not just about raw profit, it's about profit after accounting for the cost of using that capital.
Exactly. It's a much more accurate picture of whether a company is truly creating value.
Because capital isn't free, right?
Yeah.
There's a cost to using it, whether it's debt or equity.
And Goizueta used this metric religiously at Coca-Cola to evaluate different business units to make sure they were truly earning their keep.
So it's a great lens for investors to use as well. when evaluating a company's performance.
Absolutely, because it goes beyond just looking at the top line revenue or even the bottom line profit.
It tells you whether the company is using its capital efficiently, whether it's creating real value.
And that's what ultimately drives long-term shareholder returns.
Okay, let's shift gears a bit and talk about another key theme that emerges from these letters, the long-term perspective.
Ah, yes, these CEOs, they're playing a completely different game than those who are obsessed with quarterly earnings.
It's like they're looking at a different scoreboard.
They're focused on building enduring businesses, not just hitting short-term targets.
And Buffett has even pointed out that the phrase long-term appears way more often than quarterly in these letters.
It's their mantra, their guiding principle.
And Goizueta, he had this great quote. He said, "The best way to ensure strong short-term performance is to focus on the long-term future."
So true. It's counterintuitive, but it makes perfect sense. If you're constantly chasing short-term gains, you're likely to miss out on the big opportunities.
You're sacrificing long-term value for short-term profits.
Exactly. It's like trying to win a marathon by sprinting the first mile.
It's not sustainable.
And these CEOs, they understand that. They're building for the long haul. They're planting seeds that will grow into mighty trees.
So for investors, the takeaway is don't get caught up in the daily noise. Focus on the long-term trajectory of the business.
Zoom out. Look at the big picture. That's what these leaders are doing.
All right, let's dive into another area where these letters offer some fascinating insights: management and compensation.
How these companies are run from the inside, how they incentivize their people.
Because ultimately, the success of any company depends on the people running it.
Absolutely. And one of the recurring themes here is the importance of aligning the interests of management with those of the shareholders.
So they're all rowing in the same direction.
Exactly. And one way to do that is through stock ownership, right? Make sure the managers have skin in the game.
So they benefit directly from the company's success.
And they suffer if the company falters. Right. It creates accountability.
Now, Buffett's approach to compensation at Berkshire Hathaway, it's pretty unique, isn't it?
Oh, yeah. He does things his own way. He focuses on rewarding managers based on the performance of their individual business units.
Not just the overall stock price of Berkshire.
Right, because those managers might not have much control over that overall price, but they do have control over their own little fiefdom.
Makes sense. And he's also not a big fan of rigid limits on bonuses. He believes in rewarding exceptional performance.
He's generous, but only to those who truly deserve it.
And he's pretty skeptical of traditional stock options, especially the kind that just reward managers for time passing.
Yeah, he thinks options should be tied to real performance, to creating value, not just showing up.
So it's all about designing compensation structures that incentivize the right behavior.
But encourage long-term thinking, a focus on creating real value for the shareholders.
So beyond just compensation, what do these letters reveal about the overall company culture that these leaders foster?
You see a lot of emphasis on quality, on doing things the right way, on building trust with all stakeholders.
Customers, employees, suppliers, the whole ecosystem.
Exactly. And there's this interesting tendency to be very open about past mistakes.
Not just dwelling on the successes.
They see mistakes as learning opportunities, a chance to improve, to get better.
It's a very humble approach, actually.
And it creates a culture of continuous improvement, where everyone's always striving to do better.
We also see some fascinating examples of how these companies have approached mergers and acquisitions over the years.
How they've evolved and adapted to changing conditions.
Leucadia National, for instance, they built their empire by acquiring undervalued companies and then improving them.
Classic value investing, right? Find hidden gems, polish them up, and unlock their potential.
And their merger with Jefferies, that was a major turning point in their evolution.
Shows how even successful companies need to constantly adapt to find new ways to grow.
Roberto Goizueta, he had this interesting perspective on the changing nature of corporate America.
He talked about the shift from single businesses to conglomerates and then to what he called a hybrid model.
Where different units within the company have more autonomy, they can be structured to fit their specific needs.
Exactly. It's not a one-size-fits-all approach.
Yeah.
He pointed to Coca-Cola's 49% solution.
Where they had this kind of partial ownership structure with Coca-Cola Enterprises and their entertainment division.
It allowed those units to operate more independently, with capital structures tailored to their specific businesses.
So it's a fascinating glimpse into how these companies have evolved, how they've found new ways to create value.
And how they've adapted their structures to fit the changing times.
Now, the very act of writing these detailed shareholder letters, it speaks volumes about these CEOs' commitment to communication.
Oh yeah, Buffett, He's a huge believer in direct communication with shareholders.
He sees it as a fundamental right of the owners.
They deserve to hear from the captain, to know what's happening, what the challenges are, what the vision is.
And Indra Nooyi of PepsiCo, she's a great example of a contemporary CEO who's really embraced this idea.
She's very focused on engaging with shareholders, on addressing their concerns.
And she's brought this profit with purpose philosophy to PepsiCo, which has resonated with a lot of investors.
Shows that you can be successful while also being socially responsible.
Okay, so as we wrap up this deep dive, what are some key takeaways for our listeners? What should they be thinking about?
I think the biggest takeaway is that these shareholder letters, they're an incredible resource, a treasure trove of insights.
They're like a master class in business and leadership, taught by the best of the best.
And they consistently reinforce this idea of long-term value creation, of being patient, of thinking like an owner.
Of making decisions that benefit the company and its shareholders over the long haul.
Exactly. And they highlight the importance of having the right kind of shareholders, those who are aligned with your vision.
Who believe in the long-term potential of the business.
And they emphasize the importance of sound management, ethical leadership, and a commitment to continuous improvement.
So if you're looking to learn from the best, to understand how to build a truly great company, these letters are a great place to start.
They offer a direct line to the minds of some of the most successful business leaders in history.
So here's a final thought for our listeners. Take a look at the companies you admire, the ones you're invested in, and seek out their shareholder letters.
See what you can learn from them. See how their leaders think, how they communicate, how they make decisions.
Because there's a wealth of knowledge to be gained from these often overlooked documents.
It's like getting a free MBA from the masters themselves.
Well said. Thanks for joining me on this deep dive. It's been a fascinating conversation.
My pleasure. Always enjoyed diving into these timeless principles.
Until next time, keep learning, keep exploring, and keep striving to build something great.
And don't forget to read those letters.
Absolutely. That's where the real wisdom is hiding.
In plain sight.
All right. Thanks again, everyone. See you next time.